Have you ever wondered what would happen if the government just printed a bunch of money to pay off its debts or give everyone $1 million? It sounds like a simple fix to a lot of problems, right? Well, today we're going to dive deep into why that's actually a terrible, terrible idea. We'll explore the real-world consequences of printing too much money, looking at some jaw-dropping historical examples. Trust me, by the end of this video, you'll have a whole new appreciation for that piece of paper in your wallet. So, let's start with the basics. The money we use, whether it's the US dollar, the euro, or the yen, is what economists call fiat money. This means its value isn't backed by a physical commodity like gold or silver. Instead, its value comes from the trust and confidence we have in the government that issues it. Think of it like a promise. You accept a $20 bill because you are confident you can go to a store and exchange it for $20 worth of goods. This system works as long as the supply of money is managed carefully. Now, what happens when a government starts printing money like there's no tomorrow? Imagine you're at an auction for a rare painting. If everyone in the room suddenly has $1 million, what happens to the price of the painting? It skyrockets, right? The same principle applies to an entire economy. When the government floods the market with new money, it doesn't create more goods or services. There are still the same number of cars, houses, and loaves of bread. But now, there's a lot more money chasing after those same goods. This leads to a phenomenon we've all heard of: inflation. In simple terms, inflation is when your money buys less than it used to. The prices of everything go up. A little bit of inflation, say around 2% per year, is actually considered healthy for an economy. It encourages people to spend and invest rather than hoard cash. But when money printing goes into overdrive, we don't just get inflation. We get hyperinflation. Hyperinflation is inflation on steroids. It's when prices increase so fast that the concept of money itself starts to break down. Let us look at one of the most famous examples in history: the Weimar Republic in Germany after World War I. Germany was burdened with massive war reparations demanded by the Allied powers. The government, unable to raise the money through taxes, resorted to the printing press. At first, it seemed to work. They were paying their debts. But the consequences were catastrophic. In early 1921, $1 was worth about 60 German marks. By November 1923, $1 was worth 4.2 trillion marks. Trillion, with a T. The stories from this period are mind-boggling. People would get paid in the morning and rush to the stores immediately because prices could double by the afternoon. Workers brought wheelbarrows, not wallets, to collect their wages. A loaf of bread that cost a quarter of a mark in 1919 cost 200 billion marks by late 1923. People used worthless banknotes as wallpaper or to light their stoves because it was cheaper than buying actual wallpaper or firewood. Life savings were wiped out overnight. A person who had diligently saved for retirement found their entire nest egg couldn't even buy a cup of coffee. This economic chaos created massive social and political instability, which, as history tells us, paved the way for extremist ideologies to take hold. Another more recent example is Zimbabwe in the late 2000s. Under President Robert Mugabe, the government seized land from commercial farmers, which crippled the country's agricultural output, its main source of revenue. To fund its spending, the government turned on the money printers. The result was the second worst hyperinflation in recorded history. At its peak in November 2008, monthly inflation reached an estimated 79.6 billion%. Prices were doubling every 24 hours. The government started printing bills with higher and higher denominations, culminating in the infamous $100 trillion banknote. This note, worth a staggering amount on paper, could barely buy a few groceries by the time it was issued. The economy completely collapsed. Supermarket shelves were empty. People reverted to a barter system, trading goods and services directly because the currency was useless. To get by, many Zimbabweans relied on foreign currencies like the US dollar or the South African rand, which were smuggled into the country. Eventually, the government had no choice but to abandon its own currency entirely and officially adopt foreign currencies. The crisis left the country's economy in ruins, a state from which it is still struggling to recover. So, why do governments do it? If the outcome is so disastrous, why does any government resort to printing money? It's often a last resort, a desperate move by a government facing immense pressure. It could be due to war, economic collapse, unpayable debts, or political mismanagement. They know it's a dangerous path, but they see it as the only way to meet their immediate obligations, like paying soldiers and government employees. It's a short-term solution that creates a long-term catastrophe. When a country's currency collapses, the effects ripple through every part of society. First, savings become worthless. Anyone who saved money in the local currency sees their wealth evaporate. This discourages saving and investment, which are crucial for long-term economic growth. Second, it destroys the credit market. Who would lend money if the repayment you receive in the future is worthless? This means businesses can't get loans to expand, and people can't get mortgages to buy homes. Economic activity grinds to a halt. Third, it leads to massive social unrest. When people can't afford basic necessities and see their life savings disappear, they lose faith in the government and the entire economic system. This can lead to protests, riots, and political instability. The social fabric of a country can be torn apart. It's a painful and chaotic process that leaves deep scars on a nation for generations. So how is this avoided? Most modern, stable economies have independent central banks, like the Federal Reserve in the United States or the European Central Bank. The key word here is independent. Their primary job is to manage the money supply and keep inflation in check, separate from the short-term political pressures that governments face. Politicians might want to print money to fund popular projects or win elections, but an independent central bank can say no and focus on the long-term health of the economy. They use various tools, like adjusting interest rates, to control the money supply without just cranking up the printing press. This separation of power is a crucial defense against hyperinflation. It ensures that decisions about the money supply are made based on sound economic principles, not political convenience. In conclusion, while the idea of printing money to solve all our financial woes might seem tempting, history has shown us time and time again that it's a recipe for disaster. It doesn't create real wealth. It just devalues the money that's already in circulation. It leads to hyperinflation, wipes out savings, cripples economies, and can cause immense social and political turmoil. The examples of the Weimar Republic and Zimbabwe serve as stark warnings. The value of our money is built on a foundation of trust and responsible management. Once that trust is broken, it's incredibly difficult to rebuild. So the next time you hear someone suggest just printing more money, you'll know exactly why that's a path we should never go down. The real solution to economic problems lies in creating genuine value through innovation, productivity, and responsible fiscal policy, not by just running the printing presses. Thanks so much for watching. If you found this video insightful, please hit that like button and subscribe to the channel for more deep dives into how our world works. And let me know in the comments, what other economic topics would you like to see explained? See you in the next one.